Hello, everyone. Welcome to video 2 of chapter 1. In the last video, we talked about taxable entities. On this video, we're going to talk more about the tax system, the Canadian tax system, especially from a federal perspective, and a bit more consideration in how we pay. So, the Canadian government has federal tax rates. And depending on which province you're in, you'll also have provincial taxes. So each federal layer, I guess you'd say, has its own responsibilities. So the federal government will take care of certain things like the military. Each province handles its health care. And even on a city basis, the municipality might handle garbage collection, snow removal. So each layer of government has its own responsibilities, and so they'll each have their own method of collecting taxes. So the province and territories are limited to the direct taxation and taxation of income in the particular province or territory. So a person who lives in Ontario, their provincial taxes will go to Ontario. Alberta can't tax someone who is a resident of Ontario and use that money for their own purposes, whereas both provinces will pay federal taxes to the overall government. So we have corporate income taxes. Most provinces and territories use federal income tax to compute the taxable income. Alberta and Quebec collect their own corporate income taxes. So a corporation in Alberta may have to file a T2 with the federal government and also file another corporate tax return with the province. GST, HST, and PST. So when we talk about GST, that's the government sales tax. That's a portion of sales tax that goes directly to the federal government. And many provinces have what's called PST, that is provincial sales tax. It's a portion of sales tax that goes to the province. Um, so Ontario uses HST at 13%. So that 13% represents both GST and PST. The GST rate, the government sales tax rate, is 5%. Ontario used 8% as the provincial sales tax. They combined to be 13%, the harmonized sales tax, and now that full 13% is remitted to the government in one go. It's done this way to help keep the process simpler for filers because they just make one payment. Whereas for provinces that have the GST and PST separate, they need to file separate PST returns for those collections. Quebec administers its own sales tax called the Quebec sales tax, QST. And Alberta and three territories, they don't have any provincial sales tax, so they only apply that federal 5% amount. So those amount combine to be the full tax. So for example, in exercise 1-3, John Forsyth resides in a province. He has taxable income of 47,000. The federal tax rate is 15%, while the corresponding provincial tax rate is 7.5%. Determine the combined taxes payable. So this is a very simple calculation. We take the income. If 15% of that income is going to be taxed by the federal government, then $7,050 is going to be collected. We're just multiplying those two numbers, 47,000 times 15%. The provincial taxes will do the same thing. Take that 47,000, multiply it by their provincial tax rate. So this individual will end up paying in total $10,575. The combined tax rate, both federal and provincial, is 22.5%. So from $47,000 earned, 22.5% will be paid out to the government. So provincial isn't based on as a percentage of federal. Provincials have their own dedicated tax rates that also need to be paid. All right, the next couple things. Oh yeah, so this is just a breakdown of GST only. There's the provinces that only use the 0%, that only use the GST. British Columbia, Manitoba, and Saskatchewan have separate GST, PST. The East Coast uses an HST, a harmonized rate of 15%, and Ontario's is 13%, and Quebec has the GST plus their provincial QST. Okay, the next few slides are going to be me talking about the tax system. We're going to talk about a bit of the policies and what goes into making a tax policy or a tax act. And then I'm going to look a little bit at how the tax act is broken down. I'm hoping that after this video, we will land on residency, which we'll cover in the next video. So, tax revenues are used to provide public goods and services. In order for the government to help provide collective benefits, they pool collective resources from the people who live in their country. The income tax policy has a distribution effect. We can help benefit lower income individuals by redistributing income and wealth. It can be a stabilization effect. Tax policy can be used to encourage economic expansion, increase employment, maintain inflation levels, and annual transfer payments made by the federal government to provinces and territories for such as healthcare and education. So tax is trying to accomplish certain goals. We want to provide public goods and services. We want to stabilize the economy. We want to help redistribute income to those who desperately need it. So these are things tax acts are trying to accomplish. Now, taxation has, we talk about two systems here. There's three possible systems, but one is, I'm going to start with progressive. Federal Canada tax is a progressive system. We have what are called tax brackets. As your income increases, the percentage rate that you pay in tax also increases. So the higher your income, the higher your relative effective tax rate. A regressive system is the opposite of that. The lower your income, the larger portion of your income is being taxed. So sales taxes are a classic example of a regressive tax system because they affect lower income individuals more than a higher income individual. What do I mean by this? Let's say I make $50,000 and I want to buy a $1,000 laptop. Well, a $1,000 laptop is 2% of my income, and I'm going to pay 13% of that on taxes. So for $1,000, there's an extra $130 that will be paid to taxes. So that $130 is about that's 0.26% of my overall income. Now, if I earned $100,000, that $130 is 1.3% of my income. So that effective tax rate, the percentage of my overall income, is higher for a lower income individual. It's 2.6% of my it's 0.26% compared to 0.13%. The higher my income, the less affected I am by sales tax. Even though both individuals are paying the same amount of tax, because the lower income is paying a higher portion of their income tax, of their overall income, that's called a regressive system. They are conceptually being hit harder by it. So progressive systems, those effective tax rates only get higher as the income gets higher. Someone who makes more income is better positioned to handle the larger tax obligation. The third system is a flat tax. Every person just pays a flat amount of income. But again, that sort of falls back into a regressive system. If everyone's paying a set amount of dollars, then those individuals who make less money will be hit harder by it. So, but arguments for a progressive system is equity. Higher income individuals have a greater ability to pay, and stability is it stabilizes after tax income. For individuals who make more and more money, in order to protect themselves from those higher tax rates, they may choose to make a more level amount of money. They want a more predictive or predictable amount of taxes each year. So it incentivizes stabilizing income amounts. But arguments against is in order to, as people who make more money, they will often try to protect, delay, or even sometimes hide some of their income. So the anti-avoidance rules, in order to catch all the different ways people can make money, can become very complex. And actually, the basic calculation for calculating income in Canada is, pardon me, pretty simple. But there's so many tax rules because there's 1,000 different ways that people can make money and you know, I don't want to say hide money, but at least find ways to protect it. Discrimination against individuals with highly variable income streams and single family units. So someone who has, if I have a business and I make a little bit of money each year, and then I have a really good year and it goes up like this, I might end up paying more taxes than someone who has a standard amount of income each year because I pay a little tax, and then a lot of tax, whereas someone's in just sort of this mid-range tax. Not everyone has stabilized incomes. A lot of business owners, function based on the market. They might have a few really good years, and then they might have a couple years where they struggle. So a progressive system doesn't work best for them, but creates more incentive for people to figure out how to stabilize their income, or if it is growing, how to recognize it steadily. There's an argument that it limits economic growth. The incentive to increase your income and wealth goes down the more income you make because you're falling into those higher tax brackets. But once you're at the maximum bracket, all of your additional income, the maximum bracket's about a quarter million, 250,000. So if you're already making $1 million, there's not really any further detrimental effect to making your next $2 million. Access to tax concessions for high income individuals. Because there's so many tax rules, the higher your income, the more likely your income's coming from various sources. The more sources you have producing income, the more opportunities you have to recognize certain expenses, defer certain tax amounts, have access to certain government programs. Um, they discourage income reporting. I was mentioning this because those higher income levels have a higher tax rate. A lot of people will want to underreport their income to try and keep themselves in a lower tax rate. So they encourages tax avoidance and even evasion. And we'll talk a bit more about avoidance and evasion later. So a flat tax rate system, a lot of people will say, well, let's just have a flat system and be done with it. And that doesn't quite help because it won't lower the overall income tax. Governments need to collect a certain amount of dollars in order to fulfill their obligations. So if we say forget the progressive, let's just have a flat income tax, that flat rate needs to be high enough to cover the budget's requirements. So lower income individuals, instead of having high income individuals paying more and low income paying less, by flattening it, low income individuals pay more and high income individuals pay less. So we don't necessarily want to do that. We don't find that more equitable. And it might not have an effect on the complexity of the system that you think. I think the belief is, well, if you make a flat tax system, it'll be very simple. Everyone pays the same. But like I said, in the Tax Act, the actual calculation of income's pretty simple. Most of the rules are trying to catch the sheer number of ways people can carry out business and earn money and have income. So following all those different business principles and practices isn't really reduced just by changing the calculation, the income calculation. Um, when they come up with tax rules, there's an idea called tax incidence. And the tax incidence is trying to figure out who's going to be affected by a specific tax effect. Um, so, for example, when we talk in the news, we've talked a lot about tariffs. So, tariffs is a tax on importers. They bring in product. But who is ultimately affected by those taxes? Does it stay in the business? Do the businesses recognize less income? Do they pass those costs on to the consumer? Is the manufacturer actually paying the cost, or is the consumer just going to have to pay higher to cover the cost for the manufacturer? If the manufacturer is able to maintain their profits, then they're not really suffering the tax policy. So we have what's called tax expenditures. So the government has a lot of programs and such to help low income or help citizens or residents that struggle or need it. But setting up a program can be costly, it can be time consuming. So one of the better ways, or the one of the more cost-effective ways of helping certain individuals is by allowing them certain credits, by giving them a monetary benefit through the filing of their taxes. So the government foregoes some revenues through tax breaks, concessions, and preferences instead of making direct payments to entities. So let's say we want to help senior citizens. Well, we could try and set up a program and they apply, and if they apply and are approved, then we'll set out a certain tax pay, a check payment. The check payment has to be verified that they're spending it on eligible expenses, et cetera, et cetera. But from a tax perspective, we can just say, hey, if we want to help out anyone over the age of 65, let's just put in a credit. Everyone over the age of 65 gets, you know, $200 off their tax bill. They will have $200. They can spend it how they want. So select individuals or groups, certain income types. If we want to encourage investment, perhaps capital gains will have a different income type, or taxpayer characteristics, those with disabilities, those who need help, we want to help. Um, so preferential tax rates for small private corporations have a reduced tax rate. They want to incentivize entrepreneurship, so small businesses pay a lower tax. That lower tax leaves more money in the company for reinvestment. And there's a few other tax policies that they or credits that are listed here. But the function that I want to get across is tax expenditures are trying to be an easy way to help taxpayers by giving them certain breaks on their tax return. But why do we use tax expenditures? Because they're less costly to administer than a separate program. The decision on what to do with the money is left to the private sector or the person who's receiving the income. It reduces visibility of government actions. Not everyone wants the government involved in their life or looking over their shoulder. So allowing certain tax breaks on a tax return that everyone has to file anyway allows them to help out without visibly being in their space. And it does reduce the progressivity of tax systems. So I mentioned that a progressive system, the higher your income, the higher your tax rate. But in order to claim a credit, you sort of need enough income for that credit to be worth it. So the individuals who make the most money also have access to the most number of credits. Um, if they don't have a disability, they're not going to get the disability credit. But someone who has high income, who has medical expenses and disability and is over 65 and they have many more tax breaks and tax expenditures at their disposal. So it does reduce the progressivity of our tax system. When we make a tax system, what are we trying to do? Well, the first thing that you want from your tax system is probably simplicity and ease of compliance. Everyone needs to file, and so we want to make it as simple as possible. Now, for many of you, you might say, but taxes aren't simple. You are currently in a course to learn about all the tax rules. But the idea is when they write a new tax law, they're doing their best to keep it as simple as possible. Again, it's more just the sheer number of rules out there are what make it complicated. We also want equity or fairness. So equity or fairness is two people who are in the same economic position should pay the same amount of tax. If I make 50,000 and my brother makes 50,000, when we do this calculation, we should come out to the same balance of, tax owing. If our situations differ, perhaps my brother has children and I don't, then his situation's different. And so he might have access to certain credits to recognize the greater financial obligation that he has on him. So equity is trying to match your situation to your tax rule. So people in the same situation pay the same. People in different situations will have different tax treatments to try and recognize their equitable positions. Neutrality is trying not to favor any one demographic over another. Like if here's our progressive tax rate, but anyone who makes over 100 is no more taxes. Well, we want that balance. We want neutrality. We want it to be roughly equally applied to everyone in the country. It needs to be adequate. It needs to garner enough income that the federal government can pay for those public resources or those public goods and services. Um, balance with international competitiveness. We want our tax system to be comparable to tax systems around the world. If someone's, we don't want there to be a clear and identifiable benefit for someone living in the UK compared to living in Canada. And the same thing as equity is for two persons. We want international competitiveness that someone who's moving into Canada isn't being unfairly detrimental to their overall financial status. So here they're broken down. So equity, simplicity, complexity. This is an evaluation of the the system. The high income individuals pay little or no tax. That's because they have access to the most credits, and by having multiple revenue streams, they have opportunities for reducing their income. So changes to there is a minimum tax. So if someone has high income, even if they have a bunch of ways to protect themselves from taxes, they do have to pay a certain minimum tax, and that's a tax rule trying to get to equity. You don't need to know the minimum tax calculation. You just need, we're just trying to establish that the tax system has things in place to try and establish that equity. We have a heavy reliance on personal income tax. There's not too much balance between sectors. Corporations only make 15 to 20%. So almost half of all income is coming from individuals. And compliance is difficult because our rules on rules on rules has made a system that's trying to be simple relatively complex. But we are going to take you through this course in Tax 2 and hopefully give you a really good broad view of all of the various tax rules that can apply for especially individuals. Um, and I don't want to worry too much about the corporations' comparative systems. All right, at this point, I would normally want to stop the video, but I feel this next section is about the Tax Act. I want to get through it quickly because I want the next video to be about residency. So the Tax Act is our source of information for dealing with federal income tax. It's a very legalistic style because it is a legal document. It outlines the laws and rules. The Income Tax Act is not required for understanding the content in this textbook, but as we talk about certain rules, we will be making references to the textbook. So the structure of the Tax Act, the Income Tax Act is such like this. So we often talk about parts, also known as divisions and subdivisions. We mentioned Division B is our calculation of net income. So we may go to a certain part of the Tax Act and it'll be broken down by section, subsection, paragraph, subparagraph. So if I was to give you a reference like this is Income Tax Act, Section 13, subsection 7, paragraph D, subparagraph I, clause A, if we wanted to get that specific, subclause L. Sorry, subclause 1. It's a Roman numeral. The reason I stumbled on that is I very rarely find myself referencing subclauses. You would if you were in a court case to say, I did this because of subclause, but normally we stop at subparagraph when we're talking about tax rules. So for example, when we talk about, I think when we're talking about certain expenses for employees, there's a paragraph F that has certain expenses and then a paragraph H, and I think it applies for commission individuals. So we might have the same subsection talking about employee expenses, but the various paragraphs apply to here's the different types of employees. I will not be so specific going through the course content. You don't need it to that detail. If you recognize Tax Act Section 20, subsection 14, that's probably good enough for you to understand what I'm talking about. But I will occasionally reference Tax Act sections when going through the course material. So I was mentioning about the parts of the Tax Act, going to the next one. So the parts of the Tax Act, Division A is talking about the liability for tax. Who owes taxes? Division B is the computation of income. Division C, computation of taxable income. So we consider net income to be different from taxable income. Net income includes certain expenses that you're allowed. Of your total income, not all of it might be taxable. There's certain, you can contribute to an RSP to protect a certain amount of your net income. And in doing so, your net income is reducing to a different taxable income. So taxes are computed based on your taxable income, but division B and C's are our steps to get there. Division D is income earned for non-residents. And division E, now that we have our taxable income calculation, now we compute the taxes, and we'll get those into the beginning of chapter 4. So to summarize the 4 steps: net income, taxable income, then we apply the gross tax, and then that gross tax will be reduced by certain personal tax credits. Additional divisions, I mentioned the alternative minimum tax. The alternative minimum tax is trying to make sure that high income individuals are paying a certain amount of taxes at least, even if their credits or situation allow them to claim or allow them to reduce that taxable income. And we are not going to go too far into the special rules. This is an introductory course. Um, okay. When they want to make a change to the tax legislation, what they'll do is they'll put out some draft legislation, some budgets, and then taxpayers are encouraged to follow or review those and give feedback so they can refine certain laws. If they say, okay, this is done, the law's going to be in place, they will normally pick a date in the future, maybe next year or as of December 15th, and they'll do that to give taxpayers time to learn the new rule and begin organizing their income and their documents to follow it for the if we know that there's a tax rule on capital gains coming December 15th, we can prepare for that new rule. We can prepare our documentation and how we treat things. So for income tax regulations, look for words prescribed or regulation in the Tax Act provision to determine if the ITR applies. And a brief note on tax treaties. So especially for non-residents who might have Canadian income but live in a different country, or Canadian residents who have income coming from another country, we find ourselves paying taxes in more than one country. So these countries all around the world have tax treaties with themselves. They'll identify certain income types and certain ways to deal with it. And the goal of these treaties is to recognize that this one individual is paying taxes twice. So they don't want to do that. That negatively affects an individual, and it's called double taxation. We want to avoid double taxation. So they'll say, okay, you collected, let's say Germany collected a certain amount of tax from an individual and they owe taxes to Canada, then perhaps Canada will get a certain number of dollars and then Germany will give that person a tax credit based on the tax treaty. We also have some foreign tax credits, which I think we'll cover in chapter 7. And so I will get to that. But just know the main goal of tax treaties is to avoid double taxation. It also allows countries to combat tax evasion because the tax evasion is basically not reporting certain income. So if tax treaties are agreements that two countries will share tax information on an individual, then it helps them catch people who are trying to hide income by keeping it in another country. Whenever there's a conflict, the tax treaties override the Income Tax Act. If there's something in a treaty that is a specific agreement between the countries, and that rule applies over the Tax Act. And here's other sources of web of information. This course is open book. You will have access to your notes and the textbook and the slides when going through the quizzes and the tests. Taxes are meant to be done by everyone, and for those reasons, we have lots of public resources. If you go to canada.ca, the CRA website, you can search almost any tax rule. You can find a summary of it. You can find links to the forms needed. So you guys are free to use all of these information sources. Oop, didn't mean to actually click on it. And I just went right back to it. Okay. So 2 more slides. I know this is really long. I'm on the long side, but I'm going to finish this up. The Tax Act outlines the laws. They're written. The only thing is, sometimes those laws are open to interpretation. I read the tax law. I think it's done this way, and that's how I file my taxes. The CRA says, no, that's not the way it's meant to be. It's done this way. And if I say I disagree, you can take the CRA, you can take the federal government to court. And the court will look over the tax rule, interpret it as best they can per the law, and make a ruling. And so, and it doesn't always go in the CRA's corner. So sometimes if someone goes to court, the courts say, yeah, we think the taxpayer did it the right way. We're going to go on with them. And the CRA may come back in a couple years and say, okay, we understand the wording of that rule was vague and led itself to certain interpretations. We've tried to update it or change it closer to our intention. So common areas of litigations is what can be deducted from business expenses or employment related expenses. Is an individual working as an employee or an independent contractor? Is their income employment or business? Establishing a property's fair market value, deductibility of legal fees and support payments. So there's lots of things that individuals and the CRA go to court over. And like I said, sometimes the CRA wins and sometimes they don't. Court cases provide precedential value in application of income tax legislation. If the court declares a ruling that says, yes, you can interpret the Tax Act in this way, that is a part of law. The court is a source of law. Because the Tax Act is a legal document that must prescribe to the court's decisions on how that law is supposed to be treated. Okay, I know that was a lecture that was very word filled. I will do my best to, well, there's only so much we can do in the first two chapters. It's very policy based and very just very much about explaining the foundations and the thought process. We get into calculations in chapter 3 onward. But yes, so thank you for bearing with me on this slightly longer video. When we come back, we will talk about residency, and we have a lot of exercises to do in that video and how to apply certain residential rules. So thank you for your time. See you in the next video.